Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. 2025 is kicked off with an air of unpredictability in political uncertainty as it sets in a bit around this continent generally and around the world. The TSX has started the trading day kind of flat. It's up now. The loonie weakened as investors continue to digest Trudeau's exit. It's actually moved around a lot over the last 3 days. And new tariff programs that have been announced from President-elect Trump. Whether they all come to fruition, we're not sure yet. Beyond the noise, our next guest says that there are areas of the market that are not only resilient, but also gaining momentum. I'm pleased to be joined by Fidelity Chief Investment Officer and Portfolio Manager, Andrew Marchese, for his thoughts on the latest market movements and investment opportunities. Warm welcome to you. Happy New Year, Andrew.
Happy New Year, Pamela.
Great to see you here. Let's talk a little bit about, I guess, the last few days, but ultimately what we've been looking at in terms of markets of the last year. There's some real volatility in markets, but not massive moves to sort of the cycle per se. What is that?
Yeah, the conventional cycle has been somewhat muted if you compare it to history. So, if you think back over 100 years, we've had some very classic boom-bust cycles, and those are typically related to central bank tightening and easing and going too far when you're tightening, and then really having to kind of loosen up the interest rates as to get you out of a recession and whatnot. But if you look at what's kind of transpired since COVID, and there's a lot of things because of COVID that filtered through to the economy. We've had a little bit of a rate hike cycle that we saw in 2022, and now cuts since that point in time. But if you look at a lot of economic data, manufacturing PMIs, service PMIs globally, ISM data, it's kind of this weird, muted,
slightly underwater,
right?
Just slightly.
Your lows aren't that low, your highs aren't that high, and you kind of meander around. And as a result, I think it actually has a material effect on the traditional market playbook. We've talked about in the past, the traditional market playbook is you have a collection of early cycle stocks, which are typically financials and consumer discretionary, transports, and that migrates through the mid, late, and then kind of a contraction or a slowing phase. But we're not seeing that usual cyclical sector rotation in the market. Instead, it seems to be driven a lot by thematics, investment factors like momentum or quality or yield. And that's leading to both absolute gains on whole for the market and then relative outperformance as well. So we're in this little bit of a different world than what we typically are in.
For the equity markets, is there any reason, there's always going to be a reason, but is there any broad reason that you can see not to still be, pretty fully invested and believe the markets are going up from here? It seems like there's a lot of liquidity and just climbing a wall of worry.
Yeah, I think so. If you look at last year, the one thing, the investment returns for 2024, and we'll talk in equities principally, I was a little surprised at the magnitude of the returns. I thought earnings would be fine last year, and they came in to be just fine. Actually, it was one of those years where Wall Street actually got it right in terms of forecasting earnings growth. What surprised me was the magnitude of returns attributable to multiple expansion. Now, we saw interest rate cuts throughout the globe last year. I think globally, I think we've had more than 60 rate cuts. And so money supply, that is a lot. Historically, it's on the higher side, not the highest, but on the higher side. And we had them without crisis. That's the other point you have to remember. So money supply has grown. It pushes people out on the risk curve a little bit. So we had multiple expansion, and the greatest multiple expansion we saw in sectors of the economy where one of two things happened. One, you had thematic-based earnings growth that was exceeding the market. So think the Mag 7 or think the themes around AI or things like that. Market breadth did expand, which is a good thing. We saw the yield curve go from inversion to positive sloping, so it pulled along financials. And when we first started cutting rates, we saw yield plays like utilities act better. So globally, financials was one of the best performing sectors, and utilities last year. Tech also did well. There were things in industrials that did very well. It pulled everything up. So you have big money supply a lot of term deposits, GICs are, globally, you're getting 5% for 12 months, kind of 18 months ago.
Kind of cash on the sidelines?
Cash on the sidelines, so that stuff all comes due we saw like big spikes in May, June, July. Well, you're not going to get 5% anymore, risk-free. So that comes into risk-bearing instruments, that pushes valuations higher. So where we end the year, 2024, is global fundamentals for growth are okay, and some are better than others, depending on the industry you're speaking of, but market multiples are high. So the macro backdrop looks a little bit more like early cycle, positive sloping curve, some acceleration maybe in the PMIs coming up here, both manufacturing and service globally, but valuations that resemble more like mid to late. So it makes it a very challenging stock picking background for investors.
We often ask for sort of a master's in financial history from you. How would you, a lot of this probably you can link back to the pandemic and coming out of it and the pieces of that. So is there a historical precedent that you would put this next to?
Not a great one. We did have a soft landing. So if you want to look at soft landings as a historical precedence, we can go back to the last one, which was very noteworthy, which was 1995. It's interesting, the 90s were one of the best, if not the best decade for market returns, equity returns. But if you look at that post-1995 through 2000, everybody will remember the dot-com bubble. So it was fueled by big CapEx build out to build out the internet, telecom equipment, et cetera, et cetera. Coupled with that, you had a lot of innovation in new chemical entities and pharmaceuticals by the likes of Pfizer and Merck and emerging biotechnology companies like Amgen. And those stocks used to trade at big multiples. So you saw a big CapEx boom related to new innovation and new innovation in a healthcare area. Kind of a lot of new chemical entities came to fruition. If you look at those sectors of the market, they traded at huge multiples. So if you're thinking we had a soft landing, monetary backdrop is still accommodative, if you use that as a precedent, relative earnings growth would get rewarded.
Right.
Those sectors, for example, the telecom equipment stocks, the Ciscos of the world, the EMCs and servers and storage, the Mercks and the Pfizers of the world, the Amgens of the world, they grew faster than the broader market, and therefore got rewarded with not only that earnings growth, but then that multiple, exponential multiple kick to their stocks, and it finally blew off, as we know, in kind of February, March of 2000.
But we are now in an AI innovation period, which has those historical comparatives, as you say. Yeah. But we weren't coming out of a pandemic before the dot-com, for instance. Like, we weren't recovering in that way.
Yeah, we did have some things like if we had a currency crisis in '97 and '98, and the U.S. Federal Reserve kind of poured gasoline on the fire in '98 to kind of deal with the turmoil of those currency crises, and that's what really got the last kind of 15 to 18 months of the dot-com bubble really kind of going in the turbo drive. But I think the precedent is noteworthy. Not to say that you'll have the same market events. You won't. Invariably, but it shows you when you kind of go through these periods of time, and there, as you were saying, there's volatility in the backdrop, the relative earnings growth does tend to win out.
Right, so, which you've got, and it's there, and it's visible. Let's just talk about the currency story right now, because it is sort of the global macro story that is coming into starker and starker relief as we get closer to the inauguration day of President-elect Trump. There is this American exceptionalism, the US and the rest. If you even just look at it through the lens of interest rates, it's absolutely there. And we're watching other currencies and bond markets around the world crack.
Right.
It's happening in headlines. Do you expect more of this?
Well, I was kind of last year, for those who have heard me speak before, I was talking about the C dollar should weaken relative to the US dollar. I was pro-US relative to the globe from a growth perspective. So all that augurs for the US would probably have to cut rates less than the rest of the world. Check, that happened.
Absolutely.
That drags capital to the US dollar. And how much more we're going to get, I think it comes down to a relative interest rate disparity argument kind of going forward. But I was surprised at why it was taking so long to happen, and then when it really happened quickly. So a few things to note. The DXY has been very strong, particularly in the last quarter of calendar 2024. The world likes a weaker USD. So we have to think about, from a bottom-up idiosyncratic standpoint, what industries or companies benefit from a stronger USD and those that get hurt by a USD. I think that's noteworthy in talking about earnings for 2025, because we have had such a big move, and it largely happened in the last 3 months of last year. So that will filter into this year, all other things being equal. Again, it happens on an idiosyncratic or industry basis. And I think, so that's how I'm using currencies and relative currency moves to think about investment. Take it down to the bottom-up idiosyncratic level, really, as opposed to thinking about it from a broader portfolio shifting perspective. So last year we were talking about it in terms of portfolio shifting. I would say, you want more USD exposure, you want more US growth exposure. Now, since it's starting to play out, you're going to have to look at it on a relative earnings growth basis vis-a-vis the valuation of that security. So it comes a little bit more idiosyncratic.
So you would almost look for evidence of an inflation issue, problem, whatever, not necessarily in a national survey, but in a corporation, in a company itself?
Exactly. So if you think about, there's a lot of puts and takes on inflation. I know that basically over the last 3 to 4 weeks, people have been talking about the US 10-year yield kind of moving up here, and does it mean the market's now consternating about inflation, and we're talking about tariffs, changes to immigration policies. I think it's too difficult to think about this in a PCE, CPI context.
That's fascinating, because we all do that. I mean, that's what we look for.
I think that's a misnomer. Like, if you just think about tariffs in general, and the book is out on that. Nobody can tell you with any degree of surety whether the US will enact or even try really to enact what they've talked about. But tariffs are inflationary to some industries and can be disinflationary to others. The same is true for changes in immigration policy. They have an adverse effect on prices of certain industries.
Like?
Farming would be one of them in the US. That prices should rise, generally speaking, but housing might actually take a hit if you change your immigration policy. So prices up in one industry, prices down in another, or at least that's the force. It doesn't necessarily mean it's going to happen, but that's the force at play. Same would be true for tariffs. And it depends on where the goods are coming from. So whether you're talking about China, Mexico, Canada, any other country around the world. So these are too hard.
PCE may not tell you exactly.
No, I think
what you're looking at.
I think you're going to get just a little bit more anxiety every day, because you're going to get headline reports. It doesn't really help you invest. So we're going to take our efforts down to the bottom-up idiosyncratic level to really answer some of those questions.
Which means getting on the phone with the CEO?
You get on the phone with companies, you go kick the tires in certain areas, you ask these questions, if we saw a 10% rise in the US dollar or a 5% rise, or if, certain number of what percentage of your goods are coming from Mexico? What percentage of your goods are coming from China? What industries would this impact the most? And that we then have to build into the forecast for earnings and cash flow on a multi-year basis. And then we kind of make our decision, is the risk adequately priced for negative earnings revision or not? Or could we actually see positive earnings revisions from some of these changes in certain industries, in which case the stock is cheaper than we think and you invest accordingly. So it really needs to be on a case-by-case basis.
With that said, and just what you mentioned about themes and also factors playing such a big role in investing last year and maybe now as well, do you see any shift there? Taking a look, let's talk about the factors a little bit. I mean, momentum has been, you wanted to get out of the way of that train. Or get on it, more likely. But do you see that shifting again with a slightly shifting market for all of the reasons you just mentioned?
Yeah, for the reasons I said, that the typical sector rotation playbook appears somewhat broken. It seems like investors and all the financial engineering that has occurred for the last 20 years, particularly the last 10 to 15, that you can invest in factors, and you don't think about securities anymore in consumer discretionary or industrial or technology, because some of these companies actually, you could ask yourself, what is Amazon? Is it a retail company? Is it a technology company?
Where does that fit?
Where does it fit? What is Tesla? Where does it really fit? So people naturally will think about securities that cross over into multiple sectors through the lens of a factor, quality. What does its ROIC or ROE metrics look like relative to others? How much return is coming from its exposure to yield in a changing yield curve environment? How much is it now? Are we building in momentum to a certain group of stocks? Here's a case in point last year. Financial stocks globally were one of the best performing sectors. You had the yield curves go from inverted to positive sloping. Trump gets elected, talks about deregulation. All that kind of stuff helped the multiples. Did the earnings forecast for those stocks change that much? Not really. Did they come in? Yeah, they came in. They didn't miss. But you got all the lift in those stocks based, I would argue, on those two things: a changing shape of the yield curve plus a change in regulation. And it happened really swiftly. In about August is when it really got going. And then, as typically what happens, momentum tends to work in Q4 because people start piling on what's working.
Right.
Right. And so now you got a sector in financials that have benefited from two kind of macro-based arguments, but has a lot of momentum on it. In a group you typically don't think of as a momentum group because it is cyclical to a certain degree, right?
Right.
Banks, insurance companies, diversified financials do tend to have a fair degree of pro-cyclicality to them.
Is there something there? I don't know if you just split it out between U.S. or Canadian financials, but I mean, is it overdone?
I would say that the valuation of U.S. and Canadian financials, chiefly bank stocks, looks historically at the higher end of its range. Now, that doesn't mean things are good. Valuation, my personal opinion is valuation is never a catalyst for price correction,
right,
whether it's positive or negative. Something has to accompany it. Valuation just tells you how much you stand to gain or how much you could fall if the fundamentals fall apart. Now, if we said that the cycle should be kind of continuing to meander upwards, hopefully that will be good for those financial stocks, and they can either A, grow into their multiples, or maybe even B, share in some smaller, more multiple expansion.
Across the markets, just sort of adding to that general thought, we started off saying there's lots of liquidity. There seems to be lots of reasons to go out the risk curve, actually.
Yeah.
And there's many arguments for saying there are puts in the market, be they Fed puts in various different ways. There's lots of room to rescue the market. What do you think that means in terms of, if you want to put an actual price on it, or just like, what does that mean in the markets to investors right now? Come back to momentum.
Yeah, you buy what works, right? That's the typical knee-jerk reaction. You buy what's working until it breaks, and then you move on to something else. I'm kind of the opinion that it's a relative, going back to the money on the sidelines comment, that money still has to kind of go into somewhere, only because of the amount of returns that we had, particularly in the US last year in markets. It's hard to conceive a backdrop where this year, at least in the US, is better than it was last year, only because I don't think you get the multiple expansion kicker. I think earnings will generally be pretty good. But that being said, is it better than the risk-free rates that you might be seeing around the globe? Probably.
Right,
probably. So as long as the earnings hold up, if the earnings don't hold up, then we have a problem, because for the valuation ranges we tend to be in for a lot of securities. But if earnings do hold up, then I think, to your point, is the levers aspect of it all. What takes you down? Things we cannot predict.
These are the exogenous shocks.
Exogenous shocks, like things like war or escalation, kind of the Cold War between the U.S. and the alliance between China and Russia, or things like maybe there's more friction between the U.S. and NATO, and these are things we can. These are things we cannot predict.
Model, really.
We can't model. So it behooves us to really just focus on the companies, and that will, from day to day play around with bond yields and therefore play around with the valuation of stocks. And you just got to kind of ride that through. It's kind of like turbulence on an airplane. You just kind of ride it through knowing you're going to get to where you got to get to. You just it might be a little bumpy along the way.
Tell me, within Canada, so we know that interest rates, the cuts, the whole rotation of that, the cycle of that got going earlier. And we know the reasons for it. We needed it, obviously. Right. So we got going earlier. What has that done to the equity story for Canada versus equities in the US? And we accept, perhaps, that there is exceptionalism there, and we kind of know that. Yeah. But if you're to take a look at the equity story, what does it look like to you?
So we had, when the Bank of Canada started cutting rates in June of last year, we had a nice move off the bottom in a lot of yield-bearing securities, as I mentioned, not only in Canada.
Stocks that trade like bonds.
Stocks that, bond proxies.
Proxies,
And then in August, the financials trade globally and in Canada really got going with the banks. I think in it's either the month of August or entirely in Q4, like we had bank stocks up 20, 25%.
Sort of after the yen currency blow up, and then that was a resetting of sorts. Well, actually, there are a couple of resets throughout the spring, summer. Not massive ones, but enough.
No, but and concurrently with that time, it became very clear to the market that the Fed was going to have to cut in September. So it got that yield curve starting to shift, and that's when people started loading up on financials, not so much consumer discretionary stocks. As I mentioned, traditionally early cycle stocks, they didn't participate because their earnings were still falling.
Not there.
Right. Where the banks were kind of fine. And so I think for the Canadian market, going back to your original question, if you don't have these boom bust cycles, it's hard to get really warmed up about a lot of commodities. We do have a lot of spare capacity in oil. A lot of the demand for industrial commodities comes still from the emerging world. Those economies are okay. You don't have that, kind of rip-roaring economic boom. So the commodities area, even though it was poor last year, I think it's kind of meandering as well. And I think you got to probably do it on a case-by-case commodity supply-demand model, as opposed to say, this is a backdrop that's really exceptional for all commodities.
Because you want to catch it on the way up, and if it's not down enough to catch on the way up,
it makes it hard.
It's harder,
Yeah, it makes it really challenging.
There's a great question coming in. You mentioned this. So your thoughts on the U.S. 10-year yield, how it's moving, and to the degree we should focus on it, which maybe is less, I don't know.
I think my personal opinion is I think it's kind of range bound. I think what you're seeing right now is an unwinding of the term premium to some degree. I don't think it's an inflationary kick per se. Now it's something that...
That's interesting, because a lot of people obviously have their eyes set on inflation or worried about that.
Exactly. I think it's the most topical thing right now as we sit here today. If you were to kind of go to the outside non-Fidelity world and kind of survey and canvas Wall Street and Bay Street, they would talk about inflation. I think people are leaping to that conclusion because of the talk about changes in immigration policy and tariffs and other policies that the Trump government may kind of conjure up, right?
Right.
I think it's too early to talk about those things, but clearly a bond yield north of 5% in the US makes it challenging on valuation for expensive securities, whether that's in the US or anywhere else. So we saw it in 2022, and some people might remember, I thought 2022 was a relatively easy year because I thought inflation was going to surprise to the upside. Interest rate hikes were going to go up far more than anybody anticipated, and that would take the starch, so to speak, out of the tech, NASDAQ, high multiple stocks, at least temporarily. And for 9 months of 2022, they really corrected. Now, the growth continued to be there, and once we got into a more accommodative stance from a monetary backdrop and money supply, then those relatively better earnings growth stories got rewarded all over again.
So interesting. So whatever amount of sort of fear is attached to the 10-year yield getting to 5, getting to a level that's unpalatable to equity markets, how do you want to be on the other side of that? To what extent do you want to be on the other side of that? Or is it, again, unclear?
That's a tough one. And I think it depends on what your time horizon is. I think in the short term, you see a lot of securities get hit, and in theory, the cheaper ones should get hit less. But what I think as an investor you don't want to do is react to things that are so short term. Keep the mid to longer term perspective and anchor yourself to multi-year stories where a company is taking market share, has pricing power, building insurmountable leads in their respective industry, or has a path to giving back capital to shareholders. Those are the things you're going to want to focus on. In the interim, like for a few weeks, a month, or whatever, you're going to get these crosswinds, and the market, maybe to your scenario, bond yields kind of move up. We're all kind of wondering why they're moving up so much. It affects more expensive stocks. And then 3 to 4, 5 months later, all that is like yesterday's news, and we've moved on to something else. So don't abandon your kind of mid to long-term idiosyncratic look on companies and fundamentals.
With that said, what's still dominating S&P 500 and US markets are these incredible companies that are leading the AI revolution.
Yep.
They're well, depends on who you ask. Some people say they're absolutely not expensive. What if they faltered?
Yeah, I think if they falter, then that casts a pretty tough light on the entire market. There's a lot of things I talked about earlier in this segment that, the AI theme has been one of the things that have been really kind of goosing market multiples out there for those respective stocks. But for things in like the semiconductor industry or the EMS industry, you've actually seen real earnings growth that has surprised to the upside. And so all estimates have been wrong. They've been too low. Now, if that were to change, it sends a clear signal to the market that, okay, maybe this AI thing isn't growing as fast as we think it is. And now we have to think, is it a short-term hiccup, or is it something more structural that will last years? Mm-hmm. And that will kind of govern the reaction by the market and those participants who are largely attributable to that theme.
Right. So, would it allow the rest of the world?
That's a tough one.
Including Canada?
Yeah, we debate that a lot. We kind of know what the rest of the world is growing at.
Right.
So it doesn't really change that. So the question is, should that rest of the world argument attract capital? Is it so much better? Well, maybe it is, at least temporarily, but does that growth that comes, maybe that whole semiconductor AI chain and it's wide sprawling, affects some of that other stuff too. And so it's like, I always say, like, okay, if we don't like something, you don't de facto just go out and buy something else because it's not it. Right. It has to stand on its own merits. So the question will be, can that other stuff stand on its own merits? And was it disproportionately cheap relative to its normalized business? If the answer to that question is yes, then I think it would get a little bit of a lift. If the answer to that question is still, actually it's a little more expensive than normalized, maybe it gets hit. It just doesn't get hit as much.
I see.
So we debate that scenario a lot, and we don't have a firm opinion one way or another. We just kind of go back and forth with each other on it. And
we know that Fidelity's on it so that everyone else can sleep at night, which is a great thing. One final thought that you'd like to leave with Canadian investors watching everything that we're watching unfold.
I would just say, I think the earnings outlook for this year right now as we sit here looks pretty good by consensus Wall Street and Bay Street estimates. The valuation argument got a little bit more challenging because we had a strong end to the year. Having said that, there are still a lot of active opportunities. I think active investing is going to be both challenging and rewarding this year if you do it right. I think some of the broader base factor calls might be a little bit more challenging than they were over the last kind of 12 to 24 months. So I think my stance has been kind of, you want to continue to focus on better relative earnings stories. And if you can buy them cheaper, great, that's perfect. That's what we're trying to do. But I think the breadth improved last year. I'm worried about maybe breadth narrowing a little bit.
It did at the end of the year.
Yeah, I'm worried about it narrowing just a little bit, not hugely so, but just a little bit as we kind of continue to go through this cycle.
Interesting. Okay, Andrew Marchese, so grateful for your insights. Thank you, and wishing you the best in the new year.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.